Turnaround. I'm the Chuck in the Markets Up Chuck. Today's post was titled, "The Death of Buy and Hold is Greatly Exaggerated." And I'm going to start with a company called Quality Systems. This is a company that helps medical and dental practices operate more efficiently. And it, to me, represents a quintessential example of how buy and hold works and when buy and hold makes sense. I've got a 10-year chart here starting in 2000. Actually, it's a 9.5-year chart starting in 2000 and going through July 7th of this year. If you look at this company, you can see that the earnings growth has been extraordinary. Earnings have gone from 14 cents up to $1.65 last year and expected to be $2.01 this year. And one reason I chose this company is they've walked right through the recession as if it didn't exist. They have put that on their balance sheet. They've compounded earnings at over 36.5%. And take special note that they started paying a dividend of 75 cents a share in 2004. And that's going to have a lot of impact here in a moment. So if you had bought this company on this day and held it to this day, look at the remarkable results you would have achieved. A $100,000 investment on 12/31/1999 would have grown to $2,652,000 over that period of time. The same amount of money would have actually cost you almost half your money. $100,000 in the S&P would have fallen by a compounded return of minus 5.2%. Now, I might add, you didn't want to buy and hold the S&P during this 10 years, but you certainly wanted to buy and hold Quality Systems. But not only did it generate this kind of growth, look at the dividend. You know, by buying it early in 1999 and getting no dividend income, when they started finally paying a dividend in 2004 and paid a very generous payout ratio, you ended up getting 75 cents a share. But since your original $100,000 bought 51,546 shares, that actually meant $38,000 in dividend yield the first time they started paying a dividend. And look how much dividend income you've received over this 10-year period. You received almost $300,000 in total dividend income, giving you a 41.1% compounded rate of return on appreciation alone. And assuming you're spending the dividends but just adding them up in terms of your total return, 42.7%. QSII, as I like to call it, or Quality Systems Inc., is clearly a quintessential example of how buy and hold makes sense and how buy and hold works. You'd be hard-pressed to get a better rate of return using any other strategy than if you'd have just bought and held Quality Systems. But now here's the most important point. This worked because you bought a company that had a tremendous growth rate, 36%. You bought it when it was in value, and you held it to where it was just, slightly undervalued, or I'll argue in value. So, the key points here are that you had great growth, you bought it in value, and you held it to value. So, that's when buy and hold actually works best. Let me now introduce the importance of valuation to a buy and hold strategy. Let's look at Walmart over the same 9.5-year period. Walmart, as you can see, was clearly overvalued. This green line represents its intrinsic value. It was worth about $14.80 down here, let's say roughly around $14, and it started the year somewhere up here around $69. So if you'd have bought and held this stock for the, Walmart for the 10 years, you'd have received 11.6% earnings growth, which is very, very attractive, by the way, and exceptional for a company of this quality and stature. Had you put $100,000 in on this day and held it to this day, your $100,000 in Walmart would have grown, or shrunk, I should say, to $69,000. You'd have actually lost 3.8% of your money. You'd have slightly outperformed the market, but you would have actually lost money owning one of the best companies in the world that actually gave you great operating results. Because as you can see, the company grew earnings by 11.6% a year, which is very attractive, as I mentioned. Now compare this to a major competitor of Walmart's, Ross Stores, another discount retailer, and you see a very similar situation in operating results. We had good earnings growth of 11.9. That's virtually identical to Walmart's 11.6, but the difference is we start this same decade, same time frame here, that we did when we looked at Walmart a minute ago, only now we got Ross Stores in value. It was trading on its green line. It gave us the 12% growth, traded a little above the green line, and you look at what shareholders in Ross Stores did over the same 10-year period where Walmart lost money because of overvaluation, even though they had good operating results. $100,000 in Ross Stores would have grown to $433,000, significantly better than the loss you'd have received in Walmart, as well as the loss you'd received in the market. And by the way, this company paid you a nice dividend along the way as well. It and increased that dividend, year after year as it paid. You can see it started paying a dividend back here in 2003. So, buy and hold made sense for Ross Stores. It did not make sense for Walmart stores over exactly the same, 9.5 or plus period here. Same economy. Everything else was the same. The only thing different here was valuation, and it really illustrates how important valuation is. The next here, using two very strong examples. And by the way, I want you to note that I stopped these examples in 2007 because I want to get rid of any recession bias here. I want you to look at Procter & Gamble over a 15-year period here where you would have bought the company in value and it ended pretty much in value. And I want you to notice it had an 11.5% growth rate. What I'm really highlighting here is the importance of the growth rate in conjunction with the valuation that I already talked about in the previous. So if you had bought and held Procter & Gamble during this 15-year period with an 11.5% growth rate, buying it in value and ending in value, you'll see that your rate of return was almost identical to the growth rate, which is what should be expected. You had 11.5 to 12% growth, you end up with a 12% rate of return, and everything was the way it should be. It made sense to buy and hold Procter & Gamble here because you got a nice, growth out of the company, a very high quality company, and by the way, you also got a great dividend, and a dividend that was increased every year. So when you add dividends into the equation, it makes it even better. You ended up making about 13% a year in Procter & Gamble, but the point is you made an amount of money that was very highly correlated and equated very strongly to the amount of earnings achievement or operating results that it generated for you as a shareholder. Now, if I equate that to 3M, where I only get an 8.7% growth rate, and I've got a pretty good valuation in the beginning, pretty good valuation in the end, what I discover here is that I end up getting an 8.4% rate of return. Again, I get a very nice dividend that grows, but at a slower rate than we saw with Procter & Gamble. But I do get nice dividend income here also, but I end up with a 9.8% versus over a 13% rate of return in Procter & Gamble. My point is, it makes sense to buy and hold 3M. It's a very conservative company. If you're happy with a 8.5 to 10% rate of return, including dividend income, it makes more sense to buy a Procter & Gamble as long as you're buying both when the economics make sense. In other words, when the companies are in value. And the last example I'm going to show here is Oracle Corporation. I want to interject overvaluation, how dangerous it can be if you buy right. For example, back here in 1994, or excuse me, early 1995, you could have bought Oracle and it was in value, but once it got so overvalued as it did, in the middle of calendar year 2000 or towards the end of calendar year 2000, it did not make any sense to hold Oracle here. As you can see, it would have collapsed. Now, buying and holding it for the entire time frame and going through this overvaluation still gave you a very attractive rate of return. This 22% grower would have generated about a 17% rate of return over this 15-year period. But my point here is you didn't want to own it here. So, I would have bought and held it through here. Somewhere in here, it made sense to get out of the stock because it was overvalued, and it would have made sense again to buy it back. So buy and hold only works if you're buying the right company at the right price. It is not a strategy that you can think of in general terms. Some of the companies I showed you today make a great deal of sense. By the way, I am going to add one more example here that I forgot to add beyond Oracle that I think is worthy of talking about. Buying and holding Eastman Kodak over the same 15-year period makes no sense at all. Here you have a company whose earnings clearly collapsed during this period, and so you'd have lost almost 95% of your money buying and holding this company on appreciation. You would have received a little dividend income, but here's a case where buy and hold makes no sense whatsoever because earnings collapsed. On the other hand, Oracle is a company that made a lot of sense to buy and hold as long as you were buying and holding it at the right time. I hope this gave you some added insight. There's a lot being written. There's many articles being written about the demise of buy and hold or whether it is a good idea or a bad idea, and my answer is it only depends. And of course, as I say in the summary closing remarks of today's written part of the blog, today's opportunity of stock prices being at such discounts, the real benefit here is you have an opportunity to buy great companies on sale, and that makes buy and hold a strategy that I believe is alive and well today. This is Chuck Harmel. Hope this was beneficial and look forward to talking to you again tomorrow. Thanks for listening.